Hi, I'm Ben from Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. Investing into the stock market can be confusing for many. With so many different financial metrics, it can look like a foreign language or even hieroglyphics. Have you ever been confused by terms which are mentioned on finance programs on the television, such as NASDAQ, FTSE, S&P 500? What do all these terms mean? A friend of mine actually thought the FTSE was something that you do under the table on a date. But if you have ever even been slightly confused by the stock market and all the various terms, then you're not alone. There has been a whole financial institute set up to make things sound very, very complex. Because if things are very complicated, then people are more likely to pay a brokerage service or a firm to invest their money for them, when in fact you can do it yourself. Now, you don't have to know what every single financial metric does. However, knowing a few key terms can give you clarity, which can then boost your confidence and encourage you to invest and make wise decisions. So in this video, I'm going to run over 10 important financial metrics you should be aware of. Everything from the PE ratio to market cap, and I'm even going to briefly look at balance sheets. Let's dive in. Bull market versus bear market. You may have heard the phrase the stock market is on a bull run, or we are approaching a bear market. Now, these terms have nothing to do with the actual animals. Bull market generally means the stock price is increasing. For example, the S&P 500 has been on the longest bull run in history over the past 11 years. Throughout this time, it's returned a total gain of 468%. Until the recent crash due to the global issue I won't mention. You can also be bullish on a stock, which means you're investing lots expecting the stock price to rise. Whereas a bear market is where the stock prices are falling or the market is going into a recession. When valuing a company, there are a few key metrics you should be aware of before investing. Starting with the real basics. A share is just a portion of a company, and the share price represents a certain amount of value allocated to that portion of the company. Whereas the market cap of the company is the total valuation of the company, which equals the number of shares times the share price. For example, companies such as Amazon and Apple have a gigantic market cap of over $1 trillion. Now, you may have heard of index funds or index investing. An index fund is basically a collection of stocks which tries to track an index, where an index is just a particular segment of the stock market. For example, the S&P 500 is an index which tracks the top 500 companies in the USA. This is often seen as the best indicator of how well the US economy is doing. Another index is the FTSE 100. This is the top 100 companies in the UK by market cap. And then you've also got the FTSE 250, which is the 250 smaller companies in the UK by market cap. Example companies in the S&P 500 include Facebook, Alphabet, which is the parent company of Google, Amazon, and many, many more. In the FTSE 100, you can expect to see companies such as BP, Shell, and many of the major banks. Brokerage firms such as Vanguard create index funds such as the Vanguard S&P 500 ETF. The goal of this fund is to track the S&P 500 as best possible. The idea behind these funds is not to try and beat the market, but just to try and mirror the market. As historically, despite the stock market's crashes, it tends to return to a much higher level and is constantly increasing. That's why many professional investors such as Warren Buffett highly regard index funds as one of the best ways to grow your wealth on the market. The price to earnings ratio, or the PE ratio. This is a very, very useful metric used to detect whether a company is overvalued or undervalued. This is a ratio between the stock price of the company and its earnings. A company with a low PE ratio relative to an industry standard could be potentially undervalued. These are interesting companies to analyse, as it's possible a stock market correction is coming. Thus, if you invest when the stock is at a low level and then the stock market corrects to a fair value, you will profit from that increase. In recent years, it has been widely known by many investors that the PE ratio of the S&P 500 is much higher than it should be. Thus, as the share price is much higher than the earnings, a market correction was predicted. Such a high share price indicates that a lot of investors are bullish on the S&P 500, and they have good reason to, with companies such as Google, Amazon, Facebook. There's a lot of optimism in the air for the S&P 500. As a rule of thumb, a PE ratio of 40 is really high, a PE ratio of 7 is really low, and a ratio of 14 represents the average over modern history. However, these numbers are relative to the stock market and industry averages. This metric is extremely useful when valuing a company. For example, during the latest stock market crash, I invested into Royal Dutch Shell, a behemoth of the oil and energy industry. Due to the global drop in demand for oil, their share price fell massively. After further analysis, it was clear that its PE ratio was very low, and it was trading at 63.6% below fair value. With earnings forecast to grow at over 12% per year and a high dividend payment of 11.63%, this was a great long-term play. Despite me being a long-term investor, I saw the price of my Shell stock rise by over 45% in just 7 days. This equaled a profit of £1,000 if I would have cashed out. Now, you would have heard me mention a dividend there. Now, a dividend is just when a company decides to pay out a portion of its profits to its shareholders rather than reinvest back into the company. This is often seen as a goodwill gesture. A company which pays a high and reliable dividend is often a good sign that the business is doing well. Most companies pay these dividends out every quarter as a thank you to their shareholders. You can even reinvest these back in automatically and let those dividends compound. Some stocks have very high dividends. For example, a lot of real estate companies offer a 10% dividend. For example, if you have £1,000 invested, you can expect to receive £100 per year in dividends from a company with a 10% dividend. In the long term, an investor with a portfolio of a large amount of dividend stocks can receive a healthy passive income. However, there is one caveat to this. It's good practice to ensure that you're not relying on this dividend income, or you don't invest in a stock specifically for its dividend, as the business can cut these at any time, and sometimes the dividends that a company is paying out is just not sustainable. And number 7, the beta metric is a way of measuring how volatile a stock is. For example, a beta of 1 is average, whereas a beta below 1 is considered less volatile than other stocks. A beta higher than 1 is considered more volatile than other stocks. For example, the online crafts company Etsy has a beta of 0.61, which offers a less volatile share price than Amazon, which has a beta of 1.54. Trading volume is just how much that stock is being traded. A big uptick in trading volume could increase the stock's volatility. Earnings reports. Companies release earnings reports every quarter, so 4 times per year. The date when these reports come out can be very important, as good news will cause the stock to rally, while bad news may cause the share price to fall. Some companies even allow shareholders to join the company earnings calls, usually done by the CEO and board members. Coming in at number 10 is financial statements. In this video, I'm going to briefly outline 3 types of financial statements. Those are the balance sheet, income statement, and cash flow statements. Now I could go into so much depth into each of these statements, but for this video I'm just going to briefly run through them. I suggest if you want to learn more about the metrics mentioned previously and financial statements that you take maybe a basic accounting course or read some accounting books, which could be very, very useful to supplement your learning. The first type is the income statement. You can check out revenue to see if it's been increasing or decreasing. You can also check out the company's net income to look for trends of an increase or decrease. Now you may look at some large companies such as Amazon, which sometimes show a declining net income. Now this may be because they are reinvesting money into expansion or more assets. You can also review the company's costs. You may suddenly see a large uptick in costs due to new overheads, employee pay rises, or even some complex legal disputes. The second type is called the balance sheet. This is an extremely important part of the financial statements. This details the company's assets versus liabilities, with both long-term and short-term debt. If you're going to be investing into a company during uncertain times or a recession, look for those with lower debt. The debt to asset ratio can help you identify and value a good company. For example, if a company's share price declined to zero and it had to liquidate and sell all of its assets, you should review that if the company had to sell all of its assets, would that cover the amount of debt which the company has? Anything left over after the company has paid its debts will be paid out to you, the shareholder. However, you can also get good companies with high amounts of debt. For example, they may have a lot of debt to fuel rapid expansion. This is of course speculative and is more risky, but could pay off with greater rewards. During a bull market, these type of stocks can be very attractive. The third type of financial statement is the cash flow statement. A cash flow statement summarizes the amount of cash entering and leaving the company. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. The cash flow statement can be split into three parts: cash from operating activities, cash from investing activities, and cash from financing activities. The operating activities on a cash flow statement include any sources of cash used for the business activities. In other words, this reflects how much cash is generated from a company's product or services. Cash from investing activities includes any sources and uses of cash from a company's investments. This also includes purchases or sales of assets and loans made to vendors. Cash from financing activities include the sources of cash from investors or banks, as well as the uses of cash paid to shareholders, for example, payments of dividends or stock repurchases. Now I could go into a massive amount of detail on each of these points. However, it would require a separate video for each to really delve into the concepts. To find out more, I would suggest reading a few investment books, watching some more videos on this channel, and getting some hands-on experience investing. Start with small amounts of investment and then build up. You can even invest from as little as £10 on many of these free trading apps such as Free Trade or Trading 212. I did a video comparing and contrasting these two apps. Also, if you click the link below, you can get a free share worth up to £100 when you sign up to one of these apps. It would be great to know your thoughts on the metrics mentioned previously. Did you understand the concepts? Are there any that you aren't sure about? Feel free to comment your thoughts below. And if you found this video informative or inspiring, go ahead, smash that like button and definitely subscribe. See you next time.